Welcome to Industry Focus, the podcast that dives into a different sector of the stock market every day. Today is Friday, August 9th, and we're talking about the e-commerce leader of Africa. I'm your host, Dylan Lewis, and I'm joined by Fool.com's Jason Hall on Skype. Jason, how's it going, man?
Great. It's funny. After working together for like 6 years now, I think this is the first time we've ever done a podcast together.
I know, and I'm thrilled because I've heard such wonderful things from Nick Seipel in the shows that he has done with you. He's spoken so highly about having you on as a guest. You know, sometimes you have people that don't give it back. Sometimes you're kind of throwing questions out there. You're not getting a whole lot back. That's not the case with you, Jason.
I like to be engaged. What can I say? I think the reason Nick really likes to have me on there is, he's an Alabama guy and I'm a Georgia guy. And I think he likes to lord it over me a little bit that his Crimson Tide seems to have my Bulldogs number. So yeah, it's nice to not have to take that beating. So,
well, this is going to be a breeze of a show for you because my college football program was so strong that they disbanded the team my freshman year. Northeastern University, Boston. We're a hockey town. We're not really meant to play football over there.
No, not so much. Not so much. Good. Well, yeah, that's one less thing for me to worry about. So there we go.
Yeah. Well, the reason I'm having you on, I know you normally talk energy and industrials, Jason. We are talking about a company that maybe has come across the radar of some fools. I know it's gotten some discussion on Market Foolery, but it's a business that you follow quite a bit, and it's coming from a part of the world that we generally don't discuss all that often.
Yes. Jumia Technologies.
Yeah, and so this is what a lot of people are kind of referring to as the Amazon or Mercado Libre of Africa, and it's basically the largest e-commerce player there. They have a lot of elements of their business that are super similar to Mercado and Amazon. I guess we can kind of detail that out, but e-commerce, logistics, payments, they're starting to follow a blueprint that these businesses have laid out.
Yep. Yeah, and I think it's interesting because if you think about the future of Africa, this is a very young country with a fast growing urban middle class population. It's 1.2, 1.3 billion people in the country, in the continents. Jumia operates in 14 countries that have a little over half of the continent's population. But the company says that they represent those countries represent like 3/4 of Africa's GDP, and almost 80% of the continent's internet users are in one of those 14 countries. So it's really working to establish itself where the consumers in Africa currently are.
One of the things that a lot of people that listen to the show and read Fool.com articles might not realize is we are not all here in Alexandria, Virginia, or the DC, Northern Virginia area. We have writers all over the world. We have folks that are looking for stocks all over the world. And it was one of those writers who kind of first put this stock on our radar.
Right. Yeah, Tyler Crow. For those of you who listen to the Energy and Industrials Thursday show and read a lot of stuff about energy and industrials, Tyler's been a longtime contributor in that to that segment. But he actually lives in Africa. He lived in Malawi for a few years. Malawi is one of the poorest countries in Africa, and he now lives in the Gambia. I think I'm pronouncing that correctly.
I think you're right.
I think I managed to get that one. And he explained that one of the challenges in much of Africa is simply availability of goods, very limited choices. He described it to me in a conversation as basically whatever the shopkeeper's cousin in another country could get into the shipping container is what people have access to buy. So something like, you think about here in the States, you think about really in most of the developed world, with e-commerce, we can pretty much buy whatever we want, whenever we want, and we can have it, show up at our doorstep within a few days. And with Africa's demographics trending really young and being very internet savvy and mobile internet savvy, and electronic payments starting to be more common and a more comfortable way to buy things, there's a really, really strong opportunity if Jumia can establish a foothold and build some scale to just be a tremendously successful business.
Yeah, I have to always take that step back when we talk about e-commerce and remind myself that even in the United States, I think e-commerce is about less than 20% of overall retail. You talk about some of the other developing countries out there where the logistics aren't as built out, and actually getting those products from online orders to people's houses, it's just a little bit tougher, even less the case. And some of that is because it's less connected. We mentioned that 1.2 billion figure before. I think only about 450 million people in Africa are active internet users. So This is a business that enjoys a couple different major growth levers. One, the growth of e-commerce. Two, this wave of people gaining access to the internet.
Let me give some context for how small Jumia is right now versus the size of the potential opportunity just today. According to company's June presentation, the total consumer and business to business spending in Africa is around $4 trillion, $4 trillion with a T. So if we take 3/4 of that and spread it across the countries that it does business in, that Jumia does business in, that's $3 trillion worth of commerce, right? That's a tremendous amount of money. Last quarter, I think there was something like 16 million euros in business that the company did on its e-commerce platform. Again, 16 million. That's just one quarter, of course, but compared to around 3 trillion per year, I mean, this is just a tiny sliver, right? I mean, this is how early it is in Africa for really one of the bigger e-commerce players in the country, or in the continent.
And if you look at the books for this business, I think it has a lot of the hallmarks of a high growth early stage story. They put up 130 million in revenue in 2018. And just as a note, the company is headquartered in Germany and they state their financials in euro. So unless stated otherwise, all figures that would be dollars are actually euro. The company put up 130 million in revenue in 2018, which was good for 38% growth over the previous year, but huge operating losses. The company lost nearly 170 million euro on those sales. And you look back at 2 years of financials that we have access to, the operating losses were larger than the top line for both years. Jason, what's the story there?
This is simply a product of how early in this business it is. It's the losses are going to continue for a time to come as the company builds scale. The bottom line is that the company simply does not have enough merchants using its platform and using its fulfillment services, and enough customers buying those products to cover its operating costs right now. It's building scale. It's going to continue to have to spend more money than it's going to bring in, and it's going to take time. It's not exactly the same, but if you go back to the early 2000s with Amazon, Amazon was generating around $200 million in negative operating cash per year. Pretty early in its business too. So, you can't draw a direct line from what Amazon was doing in 2009 to Jumia today and say, oh, this is going to make me rich, because the risk is that the company is not going to pull it off. But again, the context is the company has to build that scale, and it's going to have to burn through a ton of cash to build the scale before the business gets to a point where the cash flows are going to be sustainable to support just the existing business.
What we've seen so far with businesses that have been successful as the de facto e-commerce or payments provider in a region is that it comes with scale. And so unfortunately, you are stuck with a growth story until you can start to realize the benefits of being number one and having some pretty serious leverage on everything that you've built out.
Exactly. And I think that's why you look at some of the traditional valuation metrics, and it trades for, I don't know what it is today, 20 times or 30 times sales, and you think that's insane, right? By any traditional valuation metric, 20 or 30 times sales is just an incredibly overvalued stock. But again, because of where it is, you kind of have to think about this almost like, an early stage biotech that hasn't actually had a drug that's passed phase 3 clinicals and it's available for prescriptions and actually just start selling and generating revenue. That's where the company is. It's investing in the business and building something that's hopefully going to get to scale to be cash flow positive.
The key business metrics here are ones that anyone that follows Mercado or Amazon is going to be familiar with. We're primarily looking at revenue, of course, but then also gross merchandise volume, as well as the number of sellers and the number of customers on the platform.
Right. Because again, those are metrics that, within the context of what the company's trying to accomplish are going to demonstrate: is it growing? Is it establishing scale? Is all of that money that it's throwing at building out its infrastructure and its platform, is it actually paying off or not? So we'll continue to watch that. Obviously, it's a mistake to disregard the cash burn or ignore the losses, because the company's balance sheet's really important, right? You want to continue to monitor its cash position, look at leverage, because it's got to pay for all that, and it went public to raise capital to be able to do that. And it has a limited amount of capital that we want to see it effectively using and using that capital to build scale, to move closer and closer to being able to live within its own means, so to speak.
To put a couple of figures to that, I think last quarter we saw roughly 58% year-over-year growth in gross merchandise volume. And then we also saw them come in at about 4 million active consumers on the platform. You think about that connected number of African citizens, there's a ways to go. I mean, that is a drop in the bucket relative to the number of people who have access to the internet in the continent. And so there's a pretty big green field ahead of them there.
Right. I mean, just going from 4 million to 40 million, 10 times the number of users, 40 million active shoppers, that's still, what is that, about 6%, 7% of the population of the countries that it does business in. So again, that's, you start doing the math and you start looking at, the orders of magnitude that it could grow and still only be a small part. And maybe that can kind of help you see how there's the opportunity for Jumia to really be, again, one of those Mercado Libre or Amazon type of investments, if you look out 10 years from now.
Yeah, and we've drawn that comparison several times, and I think that that's a comparison that Jumia welcomes. They even in their own conference calls and in their own investor presentations stack themselves right next to Mercado Libre, Amazon, and Alibaba. And there's one in particular that I want to hone in on, where they have this table breaking down all four of those businesses and their various offerings. So you have their e-commerce, logistics, payment, fintech, et cetera. And Jumia plays in a lot of the spaces that these other companies do. But then you also have Amazon in digital entertainment, marketing, advertising, cloud, same spaces that Alibaba plays in. And I think that beyond where they currently exist, there's a pretty clear roadmap here in different ways that they could monetize this audience and this group once they get to a larger critical mass.
Yeah, and I think it's interesting, right? Because you start talking about getting to that critical mass, and then it opens up optionality, which is something that we definitely like, and I'm a big fan of with businesses that have the ability to go in different ways with their capital, depending on what might necessarily generate the biggest rate of potential return, please the most customers, attract more customers, and that's a really interesting thing to consider. One business that Jumia doesn't highlight that I think is actually maybe one of the best current kind of, if you think about scale and size comparisons, and I'm going to murder this name, but it's a Baozun, Bouzun, the Chinese e-commerce platform provider and logistics provider. And there's some similarities there in terms of it's a little bit smaller. It's still getting started. I think one of the reasons they don't necessarily highlight it is that its stock hasn't maybe performed as well as Mercado Libre, Amazon, or Alibaba in recent history. But again, I think so. That's you think about it. These are successful businesses. Also, Jumia is the one that's not cash flow positive. All of these other businesses generate positive cash flow and operating profits. So again, it gives you that roadmap, as you've talked about, of the way that this business could potentially evolve if management continues to execute.
And I think a lot of that stuff will come way down the road. We talk about Amazon's ad business now as like this wonderful high margin business. It's becoming a threat to Google. It's becoming a threat to Facebook. Digital ad spend's going there. Well, we only started reading headlines about this a couple of years ago, and for how old this business is, it was a fairly mature company that then was able to roll this in because they had the captive audience. I'm not expecting Jumia to hop into these spaces anytime soon, but once you're there and you have the built out marketplace. Like you said, optionality galore. All right, Jason, we could not speak only bullishly about a stock. We got to temper some of the enthusiasm here. And this is a stock in particular, I think, that has had a major hit to it just shortly after going out on the public markets. This is not a company that's been trading for a long time, IPO'd earlier this year, and pretty much immediately after the public offering, there were people out there questioning some of their books.
Yeah, it's if anyone has, if you're a follower of The Fool at all, you're probably familiar with Citron Research, Andrew Left. It seems like a lot of stocks that David Gardner has recommended over the years have been targeted by Mr. Left as for some reason being overvalued, and he's one to bandy around things like fraud pretty regularly in his reports, and he came after Jumia pretty hard and really early, like in May. I think the stock IPO'd April. I think it IPO'd. So within less than 2 months, and essentially made claims that the company was regularly, actively, presenting fraudulent numbers with things like orders and gross merchandise volume and merchant figures and that kind of stuff. And I've read his reports. I've clicked on the links and looked at the supposed evidence that he's presented. And honestly, I don't see anything that he shows as evidence to support the fraud that he's talked about. I haven't heard a single regulatory agency that's gone after the company or announced any investigations. That doesn't mean that it's not happening, but there's just nothing there that I've seen to really support it. He's heavily featured tweets from an African entrepreneur named Rebecca Enon Chong. So hopefully I'm pronouncing her last name right. Enon Chong. She's had some pretty unfavorable things to say about the company, and some of her tweets are, basically saying, "Hey, this research report says that it's a fraud. I agree." She apparently was a property owner and was a landlord for Jumia a few years ago. She's never been involved in the company anything more than just as a landlord. But honestly, as looking at her tweets and reading it, everything that I've seen is that it seems to be, from my perspective, that her motivations seem to be more that she's very pro-African business. And Jumia is a German company. It was founded by Europeans. It's not headquartered in Africa. Most of its high-level employees, they're engineers. They're based in Europe. And the employees that they have in Africa are people that work in warehouses and do product delivery and that kind of thing. And to paraphrase what she has said is that she doesn't want this to be the media, if the company fails, reporting African e-commerce company fails, but she wants it to be German e-commerce company fails in Africa. So again, all that to say, I don't really think that the risk of it being a fraud is the thing I'm really worried about. I think the bigger risk, and it's a legitimate risk, is that it simply fails to build a successful business in the markets it's targeting, and continues to burn through cash without really establishing itself.
Yeah, I will tack onto that this will probably be a business that goes through some of the lumps that Mercado Libre goes through, where you are working in several different countries, several different currencies, and as those individual economies get hit or experience growth, you're going to experience issues with the reporting that you do if you're bringing it all back into one central currency, in their case, euros. I was talking with Danny Venna about Mercado Libre. He's a fool that's been following that business forever. And he said, the reality is you just need to expect this company to sell off about 40% once a year. And it'll also grow considerably, and it's been a great stock to own. But because there are these huge lumps in, all these different economies, and you are always bringing money back to one central currency, you're going to have some exchange rate issues with that.
Yeah, I think in addition, also, as we've seen with Mercado Libre, in Latin America and South America. I mean, there's legitimate geopolitical risk too, right? Africa has had its share of coups and economic struggles that come out of political strife in many of the countries there. And I think for the most part, the places that it's chosen to do business are relatively stable economies. They're growing pretty well. But again, these are things that, whether they're reality or just the market's perception, they're going to play a role in how the stock responds over time. And I think the key thing is you have to acknowledge those risks, and you have to accept the fact that this is definitely a higher risk stock, on the spectrum, simply because it burns more cash than it brings in. And it could not stop all of its investing and growing its business and say, okay, well, we can be stable now if we just cut our investments, because its business isn't big enough at that point. It has to keep spending just to get to a scale to even be sustainable, and it's not at that point. So that by its definition makes it a high risk investment.
Yeah, it is not a business that you want to own. You want to own the future business. Unfortunately, you got to pay a ticket to the show now if you want to see the show later, right, Jason?
Yeah. I hate I hate this cliche. It's the cost of doing business, or it's the price of admission, but it's true. You have to be willing to take on that risk if you want, if you want to own Amazon that's worth $1,800, $1,900 a share, and is a 20,000% gainer for you. You had to buy it in 2002 or 97 when it was burning more cash than it was bringing in. So that's the reality of these you have to take on that risk if you want to get the upside. So
one of the reasons I wanted to have you on the show was you are a Jumia shareholder.
Yes.
And I was kind of interested to check in with you on how you feel. In some ways, I'm reminded a little bit of the crazy ascent that iQIYI had shortly after going public, and the sell-off that happened immediately after that hype wore off. That's a little bit of what we've seen here. I think the stock doubled, maybe even tripled from IPO price, and we are down now about to where it debuted. How are you feeling as a shareholder?
Yeah, it's about the business. I essentially feel the same way I did when I first invested. I feel confident that the management's doing the right things. They're investing in delivering growth. I do have a regret, and the regret that I have is not taking the advice that I'm going to give anybody that's listening on this show, and that's simply that I invested too much too quickly. I have a pretty sizable position. It's down about half. Because I just bought a ton in the first, month or so after IPO, and didn't give the business time to play out before I gradually put more. Now, with that said, I'm 42. I'm going to be buying more of this stock. I'll probably buy more before the end of the year because I'm regularly putting more money in. But this is a business I'm not, again, like you said, you're not buying the business today. You're buying the business that it's going to become. And, I think any investor who's got a decade or more to let it run and can take on the risk that this is not the next pets.com. Anybody that was around during the .com bust back in, the early 2000s remembers pets.com. If you can take on the risk that it is the next pets.com and it's not Mercado Libre, in other words, you take on that risk that you lose, however much you put into it, consider buying. But again, this is where diversification comes in, right? Tom Engel, who is a longtime friend of the Fool, has said on the message boards, a lot of times this is the kind of stock that if it works out, you don't need much. If it doesn't, you don't want much. So start small.
Yeah, I'm curious, Jason. I have my own tricks for kind of curbing my enthusiasm when it comes to a stock I'm excited about. I tend to buy my positions in third or fourths, and I commit to not buying within about a month of each buy. So I kind of have to pace myself out a little bit. And so, maybe a little earlier than I want to. Sometimes I'll buy that first slug just as kind of a tracking position to see what's going on, make sure I'm kind of keeping up with what's going on in the business. And then over time, I'll add opportunistically after I see some more earnings reports and things like that. Do you have any guidance out there for people that might be interested in doing something similar and avoiding kind of going all in at once?
Yeah, I think one good thing to do is, if you really like a company and you've done your initial due diligence and you're ready to invest, start yeah, like I said, start small. Some people buy in thirds, and again, it depends on what stage you are in life. If you're a young investor who's going to be, buying new stocks for the next 25 or 30 years, you could be buying every year, right? It might be a company that you target to do that with. But my general suggestion is a good way to do it is to take that initial bite and then wait for one or maybe even two earnings periods to go by, not just to look at the results and the trends and see where it's going, but also to get some idea of what management has to say. Are they starting to change their tune and start giving more excuses about the results? Or are they sticking to their guns and saying, this is what's working, this is where we're going to continue to invest? So you can kind of get a feel for what management is saying as well as what the company is doing. And then once you understand the business trends, then you can kind of start looking at the stock price and say, well, I see the business is doing this and the stock's fallen by half. The thesis still holds. Now is just a better opportunity to buy. Okay, now I can buy. So by focusing on the business first, you kind of force yourself to be a little more disciplined to follow the business and not the ticker price. And that's a much, much healthier relationship to have with your stocks. That's kind of my basic thesis for most of my investments is I focus on the business and then I look at the stock price, and it's just a little bit easier to kind of hang in there if things aren't going well, or to avoid selling a stock that's gone way up just because it's gone up if you understand the business is just getting started.
So to sum all that up, you are holding your shares and probably will be buying more over time.
Yeah. I think I think I would go from probably to very likely to buy shares before the end of the year.
Okay. And for me, especially now that it's down to IPO price, I am far more interested, and it is near the top of my watch list. It's a business that's very interesting. I would like to see some of the fraudulent cloud hanging over it clear up, but I'm willing to have a small position in the company as a tracking position to start.
I'm going to throw one more thing in there about that, the fraud and all that kind of thing. The interesting thing is if you look at short interest, I think at the peak, less than 10% of shares were held short. And I think at the most recent report, it's like 6.8% of shares. Now, that's still a large amount, but this isn't the 10, 15, 20% or more of shares held short that other Citron research reports have generated. I don't know that the market is really completely buying the fraud story. So I think that one might have already kind of answered itself to a certain extent.
All right. Well, we'll see in the coming months. Thanks so much for hopping on today's show, Jason.
Absolutely. Always fun. Let's do it again sometime.
Let's do it again. Listeners, that does it for this episode of Industry Focus. If you have any questions or you want to reach out and say, hey, you can shoot us an email at industryfocus@fool.com, or you can tweet us at MFIndustryFocus. If you're looking for more of our stuff, subscribe on iTunes or check out videos from the podcast on YouTube. As always, people on the program may own companies discussed on the show, and the Motley Fool may have formal recommendations for or against stocks mentioned. So don't buy or sell anything based solely on what you hear. Thanks to Austin Morgan for all his work behind the glass today. For Jason Hall, I'm Dylan Lewis. Thanks for listening, and Fool on.